Greetings everyone and welcome to lesson 21. Now from this video onwards we start a new series called derivatives. So far in the last videos we have seen about basics of equity markets and technical analysis. For those who are thinking where are the lessons from video number 15 to video number 20, I would like to show them. Just go to our YouTube channel and in that you have playlist. In the playlist go to technical analysis. Here you have videos from lesson 8 all the way till lesson 20. So here we have discussed about technical analysis in detail. Now from today onwards we are starting lesson 21 and this is a new beginning to derivative segment. So from today onwards we will be talking in detail about Indian derivative markets or equity derivative markets. We are going to see what are the rules and regulations of derivative market and how it can be combined with the technical analysis to make profits in stock markets. So without wasting much time, let's start. In lesson number 21 we are going to talk in detail about what is derivative markets, what are tradable derivatives, and we are also going to introduce you to futures concept. So let's get started. First of all, let us try to understand when was equity derivative market started in India. Now equity derivative market was started in India in year 2000 by NSE. National Stock Exchange was the first exchange in India to introduce derivative markets or futures and options to Indian retail traders and investors. In the year 2000 we started with trading in derivative market, but that time we could only trade in index. We have learnt about index like Nifty, Bank Nifty in our previous lessons. However, from year 2001 we got futures for individual stocks or scripts also. So in the year 2000 when NSE released trading in futures, they were experimenting with trading in index only. However, as trading on index stabilized, they introduced trading on futures as well. Now futures market are quite different than equity trading markets because the rules and regulations are quite different. Before we start here, I want to tell you what do you mean by a derivative. Now the word derivative basically means that a product has been derived from something else. That means it does not has its true identity. Its identity has been derived from something else. Indian market, equity is an independent entity. However, there are a lot of direct and indirect derivatives associated with equity markets. Now think about this. Like I can say that inflation is a derivative of equity market, an indirect derivative of equity market. We see when the market crashes down, recession comes and a lot of people lose their job, because of which the economic crisis also happen, because of which inflation rate increases and decreases also. Now there are a lot of indirect derivatives like that. Unemployment rate is also an indirect derivative of equity market. As the market crashes down, more and more people lose money. So there are a lot of indirect derivatives. However, there are few direct derivatives also, and there are few tradable derivatives also. Now in the tradable derivatives in Indian market, we mainly trade into two segments called as futures and options. In today's video we are mainly focusing upon what are future contracts, how they are formed, and why are they called as derivatives. We will try to learn the basic foundation of Indian future market, and let us try to understand it with a simple hypothetical story. So the hypothetical story goes like this. Assume there is a chips making company, a company similar to Lay's, that has come to India to set up their manufacturing unit. Now this company, let us say, is from America. Now they have come to India to set up their chips manufacturing unit. They want to produce potato chips and sell it in India to make profits. Now let us say they have established and set up their production plant and have appointed managers to bring good quality potatoes to the unit. Now what is the role of these managers? These managers basically have to talk to farmers, negotiate with them and bring best quality potato at a very reasonable price. right? So these managers go to farmers and have negotiated for the price of the potato, and they have bought, let us say, best quality potatoes to the unit. The transaction that occurred between managers and farmers was in the form of a future contract. Let me explain it to you how the conversation between managers and farmer would have looked like. So let us say here we have this manager who is from chips manufacturing unit, and we have a farmer. Now manager is basically going to this farmer to ask him for potato. Now when manager is going to farmer to ask for the potato, he will not ask he wants 1 kg of potato or 2 kg potato or 5 kg potato, right? The manager would ask in a bulk quantity. Manager would say that I want 1 ton of potato or 10 ton of potato or 50 ton of potato. The quantity that manager would ask is a very big quantity, because if he would only ask for 1 kg or 2 kg or 5 kg, farmer might not be willing to grow for him. That is why when manager approaches farmer, he would obviously ask for a considerable quantity or a big quantity. Now when manager, let us say, has proposed for 1 ton of potato, farmer will be interested in cultivating it and delivering it to manager. However, farmer and manager would negotiate for the potato prices. Let us say in the market currently, let us say price of potato is say 30 rupees per kg. Now do you think the transaction between manager and farmer would take place at this price? Definitely not, right? So when manager and farmer would negotiate for the potato pricing, farmer would ask for say around 20 rupees per kg. However, manager would ask for say around 10 rupees per kg. They would try to negotiate, and let us say finally they agree to 15 rupees per kg. Now this is the price at which manager and farmer have agreed, and manager wants 1 ton of potato. Now think about this, that in the market the potato price is 30 rupees per kg. That was the reference point for the manager and farmer to negotiate. However, let us assume that the potato price in the market was say 5,000 rupees per kg. Now if the potato price in market is 5,000 rupees per kg, do you think they would negotiate at 15 rupees per kg? Definitely not. That means whatever is the price in the market, based upon that, taking that as a reference, we negotiate, and based upon that we form an agreement. So I can say that this negotiation of 15 rupees per kg is indirectly derived by the market price, right? So in the market the price was 30 rupees per kg. However, in their negotiation between manager and farmer, the potato pricing being 15 rupees per kg is derived with that market price of 30 rupees by taking that as a reference. That is why we say that this is an independent quantity. However, 15 rupees per kg is its derivative or derived from it. Now, when farmer and manager have decided that manager wants 1 ton of potato at 15 rupees per kg, farmer would say that I would need around 2 months of time to cultivate it. Now manager also understands this, and he has to give him 2 months of time. So today manager and farmer decides that okay, around 2 months from now we would meet again, and I would give you money for 1 ton of potato and you would deliver me potato. So that way, let us say they decide to meet on around 1st of July. So on 1st of July, farmer is obliged to give 1 ton of potato, and manager is obliged to give farmer 15 rupees per kg into 1 ton, that is around 15,000 rupees. Now this agreement that has happened between manager and farmer is called as future contract. So what are the specification of this contract? They have mentioned at what price they want to buy and sell, how much quantity, on what day, and the commodity, that is potato. So any future contract is basically a standardized contract. Now what do you mean by standardized? Standardized basically means there is no scope of negotiation. That means on 1st of July, when manager and farmers would meet each other, manager has to pay him 15,000 rupees and farmer has to deliver 1 ton of potato. If one of the party doesn't fulfill the condition, then the other party can impose penalties on them. So standardized contract basically means a fixed contract where there is no scope of changes or negotiation. That means on 1st of July, neither a manager can make any excuse nor farmer can make any excuse. They have to deliver what they have promised upon. And remember, on 1st of July the price will also not change. Price will stay at 15 rupees per kg only. Say today the price in the big bazaar is 30 rupees per kg. However, on 1st of July when they meet, the price goes to say 100 rupees per kg. Then manager is in an immense profit, because in the market the potato which are available at 100 rupees per kg, he is able to get at just 15 rupees per kg. That time farmer cannot charge him extra. Similarly, if the prices on 1st July, let us say if they fall to 10 rupees per kg, then manager cannot say farmer that I don't want to buy from you, I want to buy from someone else. Manager is still obliged to buy potato at 15 rupees per kg itself. So irrespective of whether the potato price goes up or down, once two parties sign a contract, then they have to obey it and they cannot default or they cannot ditch the other person. That is why in futures are basically contracts or legal agreements between two parties. So let us say on 1st of July they meet and they do the transaction, and transaction is very smooth. Manager is happy with the quality of potato and farmers is happy about the instant payout that he has received. Now if manager and farmer wants to work together ahead, then let us say manager can offer farmer multiple contracts. That means manager can offer farmer to grow crops for him for the next 6 months. So every 2 months farmer is supposed to give manager 10 ton of potato. Now for the next 6 months, manager and farmer can decide the pricing today itself. Say so after July, for the September month, manager and farmer negotiate and decide the price to be say 20 rupees. So irrespective of the potato price in the month of September, they would do the negotiation at 20 rupees itself. Similarly, today itself they can decide the price of November month contract to be say 22 rupees. So irrespective of the prices in the month of November, potato price would be 22 rupees itself in their transaction. Similarly, in the month of January, randomly take a price of say 17 rupees. So in the month of January, when manager and farmer would meet again, then the transaction would take place at 17 rupees per kg. That means two parties can have multiple contracts among themselves also, and on the day the contract is exercised, that day is called as the day of expiry. So in our example, we saw that this 1st July when they are doing the transaction, this is called as expiry date, because this contract is useless from 2nd of July, because the contract has to be met up or the transaction has to be completed on 1st of July. From 2nd of July there is absolutely no use of this contract, or the value of this contract is 0, or we say that this contract is expired. So on similar grounds, Indian future market works. So this was a brief hypothetical example to make you understand how Indian future market works. In the next lesson, we are going to talk about Indian future market in detail. We are going to talk about most popular terms like lot concept, what is lot, and then we are going to talk about future pricing, how future pricing is different from equity pricing, or basically how future pricing is derived from equity pricing and why it is called as a derivative. We are also going to talk in detail about future margins. There are two types of margins, span margin and total margin. We are going to talk about that also in detail. Then we are going to talk about other important terms like rollover and expiry, and also we are going to basically differentiate between equities and futures so that a user understands what are equities and what are future in detail. We are going to talk about all of this in our next lesson. Thank you so much for watching this video. Spread knowledge because it's free, and if you like our video, do like, subscribe and share it with your friends, and I'll see you in the next video where we are going to talk about Indian futures in detail. Thank you so much.